In this video, we're going to talk about 8 mistakes that beginner investors make when it comes to navigating the stock market. I really felt compelled to do this video now because everywhere you turn, when you turn on the news, there's nothing but information about the stock market literally crashing, and it feels like the sky is falling if you're trying to figure out this whole stock market situation. And I think it's really important to come on and share some of these details about beginner investor mistakes because the news is a really daunting area that can sway your decision making when it comes to becoming a long-term investor. And I certainly wish I had this information starting out because it definitely would have given me the urgency to start my purposeful investing journey a lot sooner. If you have been following our channel and our story, my husband Joseph and I have started Permission to Be Wealthy, which helps us share with you having open and honest conversations about wealth, financial independence, and giving yourself permission to be wealthy. If you like the content that you have to hear today, go ahead and like this video for the YouTube algorithm. We would really appreciate it. Subscribe to our channel. Joseph and I have a plan in 2022 to post 3 videos a week. One, a topic covered by me, one, a topic covered by him, one, a topic covered by us as a couple. So welcome. All this information about the stock market is literally spread across the news everywhere I turn, and maybe my news feed is primarily financial and market type information, but some of the things that are leading to the most recent, and I would call correction right now, not necessarily full out recession, is number one, the Federal Reserve did communicate that they plan to raise interest rates this year in and around the March timeframe. And this could range between 3 times to 4 times, whether it's this year alone or in the next couple of years, right? Interest rates have been at an all historic low. Any inkling that interest rates can go up just means that borrowing money or getting access to cash becomes that much more expensive. So that's certainly an area that is impacting the sell-off that you're seeing in the stock market at this point in time. The other thing is in the market in general, and I can certainly attest to this in the business that I help to support and manage in my corporate job, the market and just the economy is starting to slow. You can see that Netflix dropped 24% alone in the last week. And that was certainly news given that their subscriber numbers were down than what they expected. You've heard news about Peloton being down, I think it's 70% in the last year. And so there's certainly indication that growth in the market is starting to slow. There is higher cost of goods as well in the market. Supply chain bottlenecks have made goods that much more expensive, harder to get, and it takes a longer lead time to even get product from one place to another in the global economy. So there's certainly pressure in terms of the cost of goods because of the supply chain bottlenecks that are still prevailing years after COVID, and quite frankly, that were happening a little bit before that. And there's a labor shortage. So all these things combined, interest rates going up, slow growth in the market, higher cost of goods, a shortage in the labor market, all these things are coming together at once, which have indication that there are going to be some tougher times in the market. If you look here at the S&P 500, we'll look at the last day, which I think was Friday the 21st. It is down 1.89%. If you zoom out 5 days, we're down 5.18%. If you look in the last month, down 8%. But let's zoom out a little bit further here, right? And this is the one thing I want you to take away from the beginning of this video to solidify my recommendation that the best time to get in the stock market will always be today. It's just a matter of how you build your mindset, your thought process, your strategy of how to take advantage of it. So we'll continue here. Let's zoom out a year. We're seeing some green. So the stock market from an S&P 500 perspective is up 14% in the last year. The S&P 500 delivers a rate of return on average about 10% throughout its history of ever existing. So 14% in the last year is not bad. Zoom out 5 years. All right, we still see significant growth here. 91% increase in the last 5 years, the S&P 500. And let's look at the entire history of the S&P 500. Here we are on this far right-hand side. Yes, we are freaking out about this little dip and blip on the radar. Yes, declines in the market are always scary. And if you're a new investor, I know there's anxiety with seeing the market decline the way that it is. If you are a long-term investor, like the Warren Buffetts of the world and others, There is a lot of wealth to be made by investing in a sound strategy and starting, even if you're a beginner and you don't have all of the information, so that your money can work hard for you. So let's get into those 8 mistakes that beginner investors make. The first mistake that I wanted to address was, number 1, literally just not investing at all. You could keep cash in a bank, and although keeping cash in a bank looks great from the standpoint of it's sitting there, you can see it increasing over time if you're saving over time. But the reality is inflation will literally deteriorate the value of your cash if you are not putting in some level of investing strategy to that money. In the last few years, right, inflation was 2 to 3% at max. And in the last year, inflation hit 6%, which was the highest that it had been in 40 years. So if you had kept all your money in a bank account and didn't invest any of that money, inflation literally ate away at your cash in the last year by 6%. Or you could have invested in the S&P 500 and had your cash that is now invested in the stock market, potentially a low-cost index fund, could have grown for you by 14%. So the difference, right, of this negative 6% and this positive 14% growth is a 20% difference between someone that might have kept their cash in a bank account and someone that may have invested in a low-cost index fund at 14% rate of return in the last year. I'll talk about personal experience. At the end of 2020, we had been religiously saving everything that we could beyond our critical expenses. And we had actually amassed over $500,000 in a savings account. Yes, that was literally sitting there, and inflation just had a heyday with it, really, at the end of the day, over the 3 years that it took to accumulate that savings. Had we put that money into low-cost index funds tracking the S&P 500 over the last 3 years, which would have included 2020 when the market took a big dip in May, we would have been making a significant amount of return on that money over time. So yes, hindsight is 2020. I don't love to admit that that happened, and certainly it's something that I wish that I could change, but I do want to share that here on this channel and make sure that you all understand the level of wealth and net worth, quote unquote, success that Joseph and I have been able to get to did not come without learning some hard lessons along the way. But the reality is we got an action plan in place, we got on the same page, we took action on that action plan, and now we're here saying, we have $1.3 million plus in net worth, working really hard for us, whether it's in the stock market or in real estate, to really help accelerate our ability to reach financial independence. So you have 2 options. You can leave your money in the bank, let inflation completely have a heyday with that money, or you can invest in the stock market. And yes, the stock market can definitely be volatile, but I would rather choose that alternative and have growth against my hard-earned money versus sit back, put my money in a drawer / bank account and not really be able to live the lifestyle that I may want to live in the future because inflation has completely deteriorated that value in cash. Beginner mistake number 2, not having an emergency fund. And this one is incredibly critical, especially after a number of people learned how critical and how important it is to have an emergency fund after 2020 happened. An emergency fund is money set aside for you that helps you cover your living expenses in the event that unplanned circumstances happen to you. That can range from illness, job loss, you having to take care of a family member unexpectedly, all those things that literally could require you to have to tap into money and potentially debt, right? If you do not have an emergency fund set aside. This is the number 2 thing that I think of in terms of the order of personal finance for some of my clients at the beginning. We first look at your income and are you investing in a 401k that your employer may sponsor? We take a look at, do you have an emergency fund? We look at your debt, whether it's high interest or low interest debt, and then we talk about your investing strategy. Not saying that you have to do those things in serial, but we take a look at that inventory of personal finance items. Emergency fund is the number 2 thing on my list. So how much should you have in your emergency fund? I'd recommend having at least 1 month of living expenses in your emergency fund. Some experts would say have $1,000 in that fund. But the reality is today, expenses are just that, expensive. And $1,000 doesn't really go a super long way in all scenarios. So understanding what your monthly living expenses are and getting 1 month of expenses in that emergency fund is step number one. Step number two, if you have a stable job, then 3 months of living expenses should be your next goal. And if you don't have a stable job, let's say that you're a contractor, the amount that you're paid or the frequency in which you're paid is not consistent, then you want to strive to have 6 months of an emergency fund. The last thing about emergency fund, which is the thing that Joseph and I are working to get in place before we reach our financial independence goal of 1.8 million, that's our FIRE number. But when we actually retire early or become real work optional, we want to have 2 years of living expenses in our emergency fund. Now, we're not going to have the 2 years in that fund now because we want that money working for us. But when we get to that point, we want to have the peace, and quite frankly, I want to have the mental sanity that we can weather any storms in the market, assuming that there are going to be some downturns, so that we don't have to sell our investments at a loss. That's our plan from an emergency fund perspective. I hope that that helps you understand the importance and why it's my number 2 item on the list, and quite frankly, my number 2 item in my personal finance inventory toolkit when I talk to my clients. The third mistake that beginner investors make is waiting too long to get into the investing game. And I've seen this come across a number of different ways. Some individuals could go, oh, I need to know every single bit of information and I have to be 100% prepared to start my investing journey. Or some individuals will just get so maniacally focused at all the detailed minutia that could go into understanding investing that they get into this analysis paralysis loop that it doesn't allow you to move forward. And so waiting too long literally sets you back from the standpoint of not being able to capitalize on time in the market and compound interest, which is the 8th wonder of the world, if you ask me and if you do some other research online. Another thing that I hear individuals talk about is, I'll go ahead and start my investing journey whenever the stock market starts to downturn or when it hits this number at the bottom. You know, if these individuals have all the information and data and analytics to make that call, let me know who they are. But I don't think anybody knows when the bottom of the market is going to be and when in a short-term period, right? So if you're trying to wait 1, 2, 3 years for the next stock market crash, which would be awesome if that happened tomorrow and I could dump all of my money that I have in savings into the stock market, but the reality is nobody can time that. So don't think that you can. I certainly don't think that I can. And don't let that be a reason why you wait to start your investing journey. The fourth investing mistake that beginners make is investing too much money all at once. So this is a marathon, not a sprint. If you're just getting started, managing $100 well, then managing $1,000 well, $10,000 well, then $100,000 and then $1 million takes time and takes some practice. By no means am I saying don't start, but what I am saying is don't scare yourself out of the market by investing too much, too fast, freak yourself out, see something negative happen to that money, and then never want to invest in the stock market again, right? So if it comes down to you wanting to open up, let's say, a Roth IRA, start with $100 a month. Work yourself up to $500 a month. Max out that Roth IRA each year at $6,000 a year, and then take on some bigger investment tasks, right? The other thing that can really help you with some anxiety around, am I investing too much and am I going to see the entire value of this just go down the drain tomorrow, is you could also dollar cost average, which means if, let's say you have a whole lump sum of $10,000 that you want to invest. Instead of investing all of that tomorrow, you can take that $10,000 and spread it across, let's say, 5 months, 10 months, and invest chunks of that $10,000 automatically and into low-cost index funds, for example, so that you don't have to worry about having to time the market. You make your investing consistent. You are literally pushing out all the noise and just making sure that you're getting that $10,000 in, but being able to take advantage of any of the ups and or downs in the market without having to overthink it. The last thing I'll say about this is I talk a lot about low-cost index funds and I talk a lot about the S&P 500. The nice thing about an index fund that tracks the S&P 500 is that the S&P 500 is always the top 500 companies, 504 to be exact right now. You literally have someone saying these are the top 500 companies today, tomorrow, 2 months from now, 5 months from now. And that list of the top 500 is constantly changing. So it's kind of a self-cleansing thing that happens in the background that you don't ever have to worry about. So I would much rather be invested in the top 500 companies that have strong P&Ls, strong cash flow, really, really sound business models, and have long-term vision and growth expectations so that I don't have to worry about researching every single individual company and putting that burden on myself as a not so expert investor, but an investor that knows that I have a sound methodology and a sound strategy that will work for me longer term. So the point of this section is really don't feel like you have to go invest $10,000 to get started today. You can literally start with $1, $100, $500 a month. You can even go into a weekly schedule, but take baby steps. I'll call them adult steps because adult steps can be just like baby steps, quite frankly. But take those steps to get comfortable with the platform, the broker that you're using. There's tons of learning to be had here when you get started. But the point is, starting is the best thing to do. The fifth mistake that beginner investors make is selling when the market is down. When you sell when the market is down, you literally put yourself at a loss. And long-term investing and a long-term investing strategy should be just that. Keeping your money in the market for 10, 20, 30 years and riding out all the ups and downs. And let's say you do reach financial independence, like I mentioned earlier, having that emergency fund for those instances when the stock market is down so that you don't have to sell at a loss, that's what it should be used for, and that's why we plan to have 2 years of an emergency fund when we reach FI. So the sixth beginner investing mistake is not having enough invested to serve your future financial needs. There are tons of Americans that will reach retirement and retire in poverty, and this is the primary reason why, because people haven't really sat down and taken a look at how much you need to have invested in your long-term strategy to cover your living expenses when you are 50, 55, 65 plus. If you watched my 401k video last week, you would have seen that I took the average salary for women age 22 all the way to 60, 70 plus. I simulated them investing 15% of their average annual salaries over the course of time. And if a woman started at the age of 22 to the age of 65, they would have had to invest about a little over $300,000 to amass more than $1.7 million in their retirement accounts. So that was just an example of a scenario of getting really specific about how much should I have invested over time, depending on what strategy you may have. Now, of course, there's a number of people that are accelerating their investing strategies to reach financial independence early. That is one thing that Joseph and I are doing. And if you want to know a little bit more about FIRE, we will certainly cover that in a video in the future. But FIRE, Financial Independence Early, can also be called the 4% rule, the Trinity study. It's got a lot of different names, but it's essentially take your living expenses, multiply it by 25, and that'll give you the number that you believe you should have invested in total to live off of whenever you reach financial independence. And so at that point in time, that number, you would withdraw 4% of it, and it should, with at least 95% certainty and beyond, cover your living expenses. So that's what true financial independence means in the sense of the FIRE movement. One other thing that you need to consider whenever you're mapping out how much do I need to live off of in the future is if you take your living expenses now, you adjust it for what you think you might have to be paying for in the future. You also have to adjust that for inflation. So just make sure you're thinking about that when you're mapping out the full set of details. But as I mentioned, we'll cover that in another video and give you some more helpful tips. The seventh thing that beginner investors overlook is not planning for taxes. Taxes are one of the biggest expenses that you are going to come across in your entire life. Some of the tax advantage accounts from a retirement perspective are your 401k, a Roth IRA, or a traditional IRA. The last one is an HSA, which really has a triple tax benefit that not a lot of people think about. So make sure you take a look into that. One of the accounts that I think is really, really powerful is the Roth IRA. It allows you to contribute to the account post-tax now, so you're paying taxes on it in the today's terms, but all growth in that account, including capital gains and dividends, are tax-free when you go to withdraw. So be sure not to overlook taxes when it comes to building out your financial planning strategy. The last investing mistake that beginners make is not being honest with yourself on how hands-on you want to be with your investing. If you want to trade individual stocks, you certainly need to put in the time, the effort to research everything. And I say that not to scare you and not to deter you from being a stock trader. That's not my intention. But you really have to educate yourself on what the company is, what they stand for, all of the details so that you are making the most sound investment for yourself. Or you may choose that you want to be a long-term investor with a little bit more of a hands-off approach, maybe more passive strategy through low-cost index funds. It's a low-cost way of being able to get into the market. You can choose low-cost index funds that track certain sectors, the S&P 500, total markets like the total US stock market, the total Asia market, the global markets if you wanted to. But that is a way that you can not have to do all the research on each individual company, but trust that the index that this index fund is trying to track will give you the same results. Another way of going about your investing strategy is choosing a target date fund. These funds are provided to you by brokers. They take when your expected retirement age should be or is expected to be, and they manage your asset allocation between stocks and bonds. In your stocks portion of the account, it could be domestic stocks and or international stocks, but that target date fund adjusts the allocation over time to be less conservative as you are reaching retirement. And the last item in this space is if you just don't know where to get started, you need help, you can hire a money coach, you can hire a financial advisor. Be sure to take into account what fees or expenses you may have to take on to hire these professionals to help you with your investing journey. But I absolutely encourage you to take the step of hiring someone if it's going to allow you to start investing $1,000 a month starting this year versus waiting an entire year to try to learn everything and feel like you have to be 100% accurately ready. Then you just lost a whole year's worth of time, or worse off, 5 years plus, because you just never got started. Look, I have made these mistakes in the past. I waited too long, I didn't hire help, or didn't look for all the online information that was literally at my fingertips to just get me started. At one point, I really wasn't thinking about taxes and what that meant to my financial independence journey, and certainly our financial independence journey as a family. But that's why this video is here. It's here to share with you that, yes, I've made a number of these mistakes, and I'm sure that you've been listening to this video going, yeah, I made that mistake too, but there's no shame in it. This was not an industry that was built with the intention of serving people like myself and potentially you. So we shouldn't feel shame about not knowing this information. If anything, we should feel really excited that you now have this information at your fingertips. You can take action and you can build your own financial planning strategy. So if you like this video, we hope you give it a thumbs up. We hope you subscribe to our channel. Joseph and I have posted a couple of other videos in the last few weeks that are here for you to also take a look at. And remember, we're planning on posting 3 videos a week covering all things personal finance, building wealth, and giving yourself permission to be wealthy.